Welcome to this Killik Explains finance video. This week, how to rainproof, as I've called it, your overall financial plan and strategy. So, where does this fit in? Bit of background, you'll have seen this before potentially, but a bit of background to get us started. So investing is about making money and avoiding nasty shocks. And what we're focusing on this time is some of that, avoiding those nasty shocks. A big one is being unable to deal with a short-term crisis or emergency in financial terms. So this video is about how to prepare yourself and your family so that you are ready for that short-term crisis if it happens. Now, a quick reminder about where this fits in. So, we all need a plan. We tend to divide a long-term plan into three buckets, if you like. The one I'm going to focus on mainly here is in and around this rainy day fund. That's the emergency funding, the short-term cover if things go pear-shaped in the short term. But don't forget that sits in the context of being able to commit the bulk of your money to something that produces long-term real returns above the rate of inflation, hopefully, and that is the equity bucket. And in the meantime, we're identifying those foreseeable calls on capital and adjusting the allocation of funds in order to be able to meet them. So I'm not going to talk about key milestones and foreseeable calls or lifetime savings much today. We're going to take those out of the picture. I'm going to focus very much on the front end, making sure we're ready in the event of an emergency. So, one thing we should do is have that rainy day fund available. So what is that exactly? Well, it is there to cover a rapid cash call. The idea of having this rainy day pot, which travels throughout your financial life with you, if you like, is so that you don't, in an emergency, suddenly force liquidate equities from your lifetime savings at just the wrong point. So it is to cover redundancy, the cost of it, short-term illness, or a pure emergency, leaky roof or something like that, just something that needs cash. And they need a dollop of cash fairly quickly. So 3 to 6 months, people say, how much do I need? Well, there is no right answer to that per se, but 3 to 6 months of your average monthly expenditure kept in a fairly low risk account will do the trick. Wouldn't personally use your ISA for that, because once you liquidate an ISA, if you don't get your money back inside the same tax year, you lose the future benefits. But a low risk, non-ISA cash account with a decent amount of your run rate of expenditure, and you'll need to do some budgeting to work out roughly what that is a sensible target. Now, what about insurance? So is there anything else you can do that might give you a little bit of cover over the short or even medium to long term? And there is. Now, these are all optional. The rainy day fund, I say, isn't optional. Everyone should have one of those. These are optional, but some of them are well worth at least considering. So I'm going to talk about income protection, critical illness cover, and life assurance. And part of the problem with the insurance market, other than you need to make sure that you're actually covered and can claim, more about that in a moment, is the jargon. So what are these three things? They're all different. What are they? And what are the pitfalls, if you like, if you're thinking about buying one of these things? They're all insurance plans, so they work on the same basis. You pay a premium every month, set by the insurance company, in return for, well, it may be in return for nothing. You may never claim on the policy, but the point is in return for a potentially big benefit if something goes wrong. And I suppose there's some clues in the name as to what could go wrong. So, income protection first. So a little bit about what it is, things to look out for, and then I'll leave you to do further investigations. So, income protection is designed to replace your income over the short or long term. There are two types of plan. There's the kind of what I call the emergency plan, and then there's the much longer style of plan. Long-term plans are usually subject to a minimum deferment period, so it's all about small print. A lot of I'm afraid with insurance you do have to read the policy carefully. Watch out for the fact that quite a few of these things don't kick in until a minimum number of months have passed where your income has been threatened, if you like. And basically do watch out for what is covered as well. So these tend to be for ill health grounds rather than grounds of, say, unemployment. You've just been kicked out by your employer. So you need to look both at the length of the plan, make sure if you want short term that's all you've got, or long term that's all you've got, look for minimum deferment periods, and always look for what is covered and for how long. So a long term version of one of these things could cover you all the way through to retirement, for example, just to put it in context. It could be a proportion of your income, it could be most of it. You do need to read the small print. And all of these things I've talked about will influence the amount the policy costs you, while, if I can put it this way, you're not claiming on it. Critical illness cover, what's that then? Well, basically, this is normally a lump sum payout, so you pay a monthly premium in return for a lump sum in the event of an illness. Now, it needs to be on the list of things that are covered by the policy. It's important to read through that stuff. But the principle is it could be a way, if you get that lump sum from the insurance company, it could be a way to, say, clear a mortgage, make changes to a property, if, for example, your mobility has been affected, or pay for equipment. So for people who basically have suffered a permanent injury, maybe that restricts their ability to work, it maybe even stops them from working, this could be a way to get a lump sum as a form of cover. Now, do watch out for definitions and exclusions, all right? These can be useful plans, but only in the right hands, as it were. Small print's vital. Look at what's included, what's excluded, look at the conditions around that, and also make sure that with all these things, you are shopping around, because premiums will vary even for the same amount of cover, simply because there are different companies competing to sell these things. And then life assurance, the final one. Now, this one, most people get automatically if they're employed. So this is the one that pays out a lump sum in the event of your death. So this is designed, this thing, something people don't want to think about on a day-to-day basis, obviously, but this puts an umbrella over your dependents, spouse, kids in the event of your death. It gives them some protection. And what it basically does is offer your dependents some financial security. Now, be really careful. Sadly, a friend of mine died having basically moved from employment to self-employment. He didn't set up life assurance, moving from employment, where he had it automatically, death in service it's called, to self-employment where he didn't, and that caused his poor spouse no end of problems when he suddenly died. So be careful. These things are automatic for employees, but they're not automatic if you're self-employed, for example. And even as an employee, the generosity of the plan may not be as much as you want it to be. So they vary. So it may be a plan that pays out 4 times your salary to your dependents in the event of your death, or 4 times your average salary, or whatever, however it's worked out. But you need to look at that detail. What is the multiple applied? How's it calculated? Okay. So basically, you won't get it self-employed. You may get it as an employee, but it may not be as much as you want. But that's the way it normally works. And these things come under different names. Death in service is what it's called for an employee normally, or life assurance if you buy it off the shelf, either to supplement an existing plan or because you don't have one. Some rules of thumb. Final points. If you are shopping around for any of these styles of policy, these are insurance rules of thumb if you like, gender, age, health, job, smoking can all affect premium. So the amount you pay will go up or down according to quite a few factors, and those are worth looking at and discussing. Read the small print carefully and monitor changes. Insurance companies are classics for saying, here's your plan now, 2 years down the line you get a letter which you shred, and you should have read it because there's a change to the policy terms. And do review as your circumstances change, for example, from self-employment to employment. So if you're self-employed and go back into employment, you may not need life assurance, for example. To find out more, editor@killik.com. And if you want to see videos around things like financial planning, rainy day funds, lifetime savings, killik.com/learn. And then, good place to start, down the left-hand side here will be the tax effective savings tab.